Welcome back to the Money Show, and moving on, let's shift focus to the equity markets, which have been volatile this particular year. While markets have inched towards their newer highs in the recent days, markets have also seen extreme volatility earlier this year. And so how do market falls affect the fund flows, and what are the factors that drive fund inflows? Let's welcome on board Mr. Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management, and he will also answer these questions. Not just that, we'll also have some understanding that how to read the various market data as well. A very good evening, Feroz, and thank you so much for joining us today on ET Now.
Hi, Shrishti. Good evening. Thanks to have me on your show.
Okay, so a very interesting topic that we have got for our viewers today. And Feroz, just reading to the data, back in 2022, Nifty gave almost a flattish sort of a return, was up in single digits. But the major factor was that the FPIs were pulling their money out of India. It was almost 1.2 lakh crores of outflow that FPIs have done, but thanks to the DIIs that did support the market movement. But if we see 2023 coming, the first half, or rather the first 2 to 3 months, they were depressing. The FPIs were still pulling out. But what a recovery, or what a comeback that they have made. 94,000 crores worth of pump in terms of investment is what they're seeing. And look at the move in Nifty 50, almost near to its life high level. So how should one read this data? Is it that so that whenever FPIs or FIIs will make a comeback in the Indian markets, then only we will see the market moving upwards, or when they are pulling out, the markets could give a depressed sort of a return? What's your understanding, and what does the history tells?
Shrishti, I'll answer this in parts. There are quite a few things which a person can infer from the piece of information which you just articulated. Firstly, I think what has happened over the last decade is a structural change of Atmanirbhar capital markets. Let me substantiate with the point. Like last year, FIIs took away 1.2 lakh crores. That's a lot of money, right? That's more than 12, 13, 15 billion dollars going out, and the market being marginally positive. That implies that 10 years back, if the same thing would have happened, markets would have closed that year with a minus 20% tick. But why did it end 1% higher in the financial year in question? That's because SEBI tried to make one change. Structurally, two large changes were made. One of which was done in 2013, and the other one was done in 2018. SEBI in 2013 started educating Indian investors to get a reasonable pie of the domestic Indian household saving. The Indian household saving as we speak is 670 lakh crore, okay, which only 21 lakh crores is equity mutual fund. Look at the power of the Indian household, 670 lakh crore. So when SEBI started educating the Indian investor by starting an education initiative using mutual fund as a platform and AMFI as a platform, that has changed the mindset of the Indian household from seeing a mutual fund as a risky instrument to the logical, most safest product platform from a transparency standpoint. That's one thing which has made sure last year you didn't fall. Second thing which SEBI did in 2018 was simplifying the life of the investor. And that's why you see 14,700 crores in a single month coming from the Indian lower strata. That's 2022 for you. And this data, why is it very important? Is because this will tell you over the next 10 years, how buoyant will our markets be? That's point one. Point two is the domestic flows have been robust, and they will become far more robust. And I have already predicted it on your show that in the next 3 years, you will see 25,000 crores every month coming in the form of SIP. I had said this when the SIP numbers were 8,000 crores, and I reiterate that you will surely by FY27 reach 27,000 crores of monthly inflows from Indian domestic households. So it will be a very buoyant market. Then coming to the volatility point, you would be very happy to note and have immense pride as an investor and an Indian that the volatility if it's numerically measured in the form of standard deviation, has been lower than the US markets, which is 100 years more older. That's because of the domestic flows. So the risk levels of India has come down significantly, because if you measure it in standard deviation, which is how volatility is measured, like return is measured in compounded returns, risk is measured in standard deviation most popularly, and we have produced lower risk than the US market over the last 1 year. And coming to 23, I personally think the FIIs will return. I was just there in Paris on a global event last weekend. This weekend, I would like to say. And I've met about 500 global investors, and their take on India has dramatically changed over the last couple of years.
Rose, you seem to be echoing the positive view on the Indian markets, definitely. But before we go ahead and talk about the other touch points like SIPs and the fund inflows, just wanted to ask you, when are you expecting Nifty to touch their all-time high levels? Because it has been a touch and go moment for the past 1 month. There has been a lot many instances. So we are just a century or maybe 200, 300 points away from the all-time high levels. But what's your expectation? When can we see that happening?
See, Srishti, to be honest, that will require some crystal ball gazing, which I don't have. But I personally think, of course, as a sentiment standpoint, as a happiness standpoint, a peak makes a difference. But if you look at a 1 year, 2 year, 3 year kind of time frame, getting more than the double-digit returns on Nifty is upwards of 90% probability. Of course, there's 10% probability of things going southwards, which is always going to be the case. But if you ask me pointed, I think this year a peak should be established. It should be around the corner, but because just 0.5% away from the peak, which is about 18,858, if I'm not wrong. We're just hovering there, and we have not touched that so far. So I think this year is going to be good. Last year wasn't good. So the probability of the future becomes better if the last 4-5 years have not been stupendous returns. Of course, after COVID, the correction, the market has moved up. Now coming to very pointed inflation, which is the global concern, doesn't exist for India, because the inflation numbers which we produce are lower than the last 10 years average of inflation. US has produced inflation numbers which are 400% more than the average of the last 10 years. So whatever is the globe's problem is business as usual for us, is why we are a brighter spot and attracting global inflows. And I think it's just scratching the surface currently.
Okay, thank you for that take, Feroz. But moving on, getting back to the SIP inflows that you were touching about, you are expecting that 25,000 crores is what you are expecting from the inflows, and now the data stands at 14,749. So that's an exponential, or rather a significant jump in the next 3 years, what you are expecting. But given the whole scenario and the setup that we have discussed, how the Indian markets are placed, which particular type of fund, be it large cap, mid cap or small cap, is expected to outperform? Because given the fact that FPIs have made a comeback in the Indian markets, especially since the March lows, the broader market space is definitely buzzing. So if one has to take a view going ahead, that now that the FPIs are once again back and the outlook is also positive, then which particular type of fund they should be eyeing at, for rather to create that alpha around?
Shishi, this is an easier question to mathematically answer than the previous one. So let me give you some mathematics. First, I'll tell you the headline. I would prefer having at least 30% in the small cap space for the next 1 year, at least 30%. On an overall implied basis. See, what happens is when you buy 10 funds, each of them might have some degree of small cap, some degree of mid cap. When you open all these 10 boxes and see the implied exposure, 30% could be in small caps, 20% in mid cap, and 50% in large cap. Mid cap being smaller than small cap is a huge message that from a relative valuation standpoint, the 150 stocks which are called mid cap stocks are a little overvalued. Hence, we think that the large cap is attractive, the small cap is attractive. The least attractive of all these three segments is those 150 stocks, which are called mid cap as per SEBI's definition. from a mutual fund investor standpoint. That's point one. Point two, why do we believe small cap will do well? Is because the rear view mirror has a very shoddy picture. Last 5 years, small cap has underperformed Nifty by 4% every year. Every time this has happened, that small cap has underperformed for 5 big years, the next 3 years have always been good for the small cap period. Since the rear view mirror is showing a very ugly picture for small cap, the probability of small cap outperforming the Nifty goes up significantly. And if history has to be believed, there is 95% chance that small cap will outperform Nifty over a 3-year holding period from now on. So at least for 1 year, you should have 30%. If small cap does very, very well over the next 1 year, if it so does, fingers crossed, then you may want to lighten your small cap exposure. But this question needs to be re-answered a year from now.
Okay, thank you so much for highlighting that data, how the small cap, when in instances it has underperformed, then one can expect the outperformance in the times ahead and how you should definitely place yourself out here. But if we talk about the return over the past 22 years, what you have shared is that Nifty in the past 22 years has given at least 12.5% of return on a per year basis. So going ahead, Feroz, do you expect this particular number to be stretched even more, given the fact that the FPIs, or like you were highlighting as well, that the FPIs are very much positive on the Indian markets, and we are seeing the retail participation coming in a big way. So what's your understanding for the markets, and what kind of an expectation in terms of the EPS for Nifty 50 is what you guys are factoring for?
Yes, so there are a lot of questions in this, Trishti. I'll try and answer, and I will try not to miss all these important ones which you asked.
Okay.
When you look at bullishness from FPIs and domestic inflows, an investor should look at this money as a risk mitigant, not as a return spinner. If you have bullish, marginally bullish FPIs and good domestic flows, then the drawdowns in the market are not going to be as steep. Like, what should an investor worry about is the COVID-like kind of situation where the markets fall like a knife. Markets every year fall from peak to trough almost 19% every year. So markets are going to fall. That's the nature of the beast. An investor needs to be mentally prepared for at least a 10-15% drawdown every year from peak to trough, because 22 years history says market will find its reason to correct. But the problem happens when a 2008 or a 2020 happens. Then an investor becomes very difficult for an investor like you and me, Shrishti, to be in the game, to look at the light at the end of the tunnel. So point one, because of this bullishness of FPI and domestic flows, markets are going to be buoyant, and sharp falls like GFC and the COVID are very, very unlikely. That's point one. Point two, coming to the EPS earnings. We were one of the very few wealth management outfits which predicted an earnings growth of 30% when Nifty's earnings moved from 535 to 772. And then last year, it closed at 840. If you remove the one-time expense of Axis Bank when they bought the Citi business, 840 was the earnings last year. We predict this financial year to be 936 earnings. So if you look at all these 3 years put together, which is how an investor should look at, 535 to 936, that's one of the sharpest earnings growth in the globe. And that's why markets have not supported a bear and supported the bulls, because the corporates are doing well, and 936 is our earnings estimate for this year for those 50 companies. And that makes markets in a reasonable range of valuation.
Okay, markets looking in a reasonable range of valuation. Thank you so much, Feroz, for highlighting and helping with whole of the study that how the FPI's inflows have impacted the Indian markets in the past, and going ahead, what is the outlook on not just the inflows, but with respect to the performance of the broader end of the market as well as the large caps. With this, viewers, it's time to slip into a short break, but hang on, Feroz. We'll be right back, and then we'll be taking all the portfolio-related queries of you viewers with our expert, that is Mr. Feroz Aziz, but just after this quick break, so stay tuned. Welcome back to the Money Show, and it's time to take all your portfolio-related queries onto the show, viewers, because we understand that there are plethora of funds that are available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that you should be looking at? And to help you navigate through this maze, we have on board Mr. Feroz Aziz, Deputy CEO at Anand Rathi Private Wealth Management. And also, do not forget to send us your portfolio queries on a WhatsApp number, that is 865-797-4571. And you can also email us your queries on the Money Show @etnow.tv. But let's get started with the first query, Feroz. And the first query is a caller. And onto the phone line, we have Advocate Walson from Kerala. Hi, very good evening. Please take it away and share your query. We have Feroz on board.
Yeah. Very good, very good evening, madam. Oh, yeah, okay. I have sent some WhatsApp messages regarding my SIPs. I have a few SIPs whether to continue or not. That's what my query. Yeah, this is regarding one. My WhatsApp message is there already, no?
Yes, we do have your message.
Yeah.
So, okay, so wish to know that amongst the SIPs that are currently running, and I see that there are in total 13 SIPs that are running, amongst them, which one you should take your money, or rather make some more investment?
I don't want to take out the money.
Okay.
I want to know whether all these funds are okay for continuing the SIP, for anything to be changed.
Okay.
Yeah.
Okay. Feroz, it's a long list. If I get to read this, then you can see on your screen that SIP Blue Chip, SBI Mid Cap, SBI Small Cap, Canara Robeco, Canara Small Cap, Axis Mid Cap, HDFC Balance Advantage, Kotak Emerging, Kotak Banking Financial, Mirai, Tata Small Cap, ICICI Technologies, and ICICI Innovation Fund. In total, Advocate Walson is doing 37,500 rupees of SIP per month. What is your understanding? And amongst these 13 SIPs that he has shared, which amongst you feel that that's the best, and what are your views on the same?
Mr. Walson, first thing is you have to get your principles right. There are some foundation principles which mathematically have got established. If you can look at that data and come to the same conclusion, which you will, I would like to try to tell you the output rather than the input of it. I wouldn't buy myself a sector fund. On a risk-adjusted basis, you will make lesser money on a long term as an investor. That's point one. I would not buy an NFO. You've bought two NFOs which have not finished a year. If there are about 380 active funds in the market, like Shrishti mentioned, there are plethora of funds. What's my reason to buy a new one which does not have any history or track record or the portfolio construct today? So don't buy an NFO. That's the second piece of advice I would give you. And there's enough data to substantiate my claim that this is detrimental from a risk-adjusted basis. The third thing which I wouldn't buy for myself is a balanced fund because I would want to keep asset allocation at investor level. You're not a person who has only 1,000 rupee SIP. If you have only 1,000 rupee SIP, you might buy a balanced fund to get the flavor of these two assets. You're doing 37,000 rupee SIP. So you please have to do the asset allocation at your end rather than at the fund level. These are three pieces of foundation advice I'm giving to you and to a listener if you wish to consider these inputs, which I've learned over a couple of decades of data crunching. That's point one. Now coming to the specific list of schemes which you've sent across to us, I would request you to consider exiting about 7 of them. HDFC Balanced Advantage, ICICI Innovation Fund is not finished a year, so you make sure that you're not paying exit loads and wait on for a while. ICICI Approved Technology Fund, Kotak Banking and Financial Services, Axis Mid Cap, Tata Small Cap, SBI, Magnum Mid Cap. These are the funds you can consider exiting. The funds you can add to your portfolio are SBI Contra, ICICI Dividend Yield, HDFC Flexi Cap, and Quant Active. These are the 4 funds you can consider investing. That will bring your total to 10 schemes. I don't think 10 schemes are too many for a portfolio with 50 lakhs of current value and 37,000 of SIP.
Okay, so that's the advice coming in for Advocate Walson. But moving on to our next caller, and online we have Mr. J. Simba Sivarao. Very good evening. Please go on and ask your question to Feroz.
Yeah. So what is the performance of the Kotak Growth Innovation Fund, Global Innovation Fund?
Okay. We believe that you already have invested in this, Mr. Rao.
Yeah. So I want to know whether I should exit or add some more. I am a long-term investor.
Okay, 25,000 units at the rate of 9, right?
Yeah.
Okay. Feroz, he wants to know the outlook on Kotak Global Innovation Fund. He has already invested in 25,000 units at the rate of 9. He wished to stay invested for the next 3 to 5 years. And like he was mentioning, he's a long-term investor. So what's your view on this?
Mr. Rao, I think the first point is if this is the sole fund in your portfolio, then the recommendation or a piece of advice would be different. If this is a constituent of an overall big portfolio, the first thing you have to check is whether this is more than 10% of your money. If it's more than 10% of your money, you don't have to wait. You should surgically make a change. If it's less than 10%, you can hold on because there's other 90% deployed in the fastest growing economy, large economy, which is India. So if you're sitting in India, we are fortunate because the next 10 years, we will be the fastest growing economy, which we currently are as well. So depends on how much more money apart from this is there in your portfolio. That's point one. Point two, I can tell you some list of funds which you can consider adding. I don't have any global fund and I don't think my portfolio has suffered. If I measure risk, I don't think the risks are anywhere different because if you're going to have NASDAQ in it, which is what Kotak Global Innovation Fund has technology stocks as well as the name innovation goes. If you're going outside the country to invest, to reduce risk and then buying technology-based funds itself increases risk. So it's counterintuitive. So fundamentally not right. So if it's less than 10%, hang on. If it's more than 10%, exit. Don't wait here for 3-5 years. I think 3-5 years, a better prospect would be India and also the alpha in India. US does not generate extra return. Fund managers are now finding it very difficult to generate the extra return. But in India, you are able to generate 3-4% more than Nifty if you chose the right funds from the plethora of the ones which are available. I'll read out some funds which you can consider. They're flashing on your screen as well. ICICI Dividend Yield, ICICI Focused, Invesco India Small Cap. These are contemporary funds which you can consider adding into your portfolio. And a few others are also flashing. DSP Equity Opportunities, Franklin India Blue Chip, and HDFC Small Cap. This is more futuristically evaluated, trying to see if they can do better than their past performance as well.
Okay, so that's the advice coming in for Mr. Rao. But moving on, the next query is an email query, Feroz, and this question is from Mukesh Kapoor. He says that he's invested in Axis Midcap, Bank of India, Small Cap, and ICICI Pru Equity and Debt Fund, and he's currently investing 5,000 rupees each in each of these three funds. How will these funds perform for the next 3 years, and how should he look at and plan his investments? What's your view on this?
Srishti, again, I have to give a fundamental suggestion to Mr. Mukesh, which is to have the basics first, which is the large cap fund or a flexi cap fund are missing in his portfolio. So starting out with a mid cap, small cap and an aggressive hybrid, you've missed out the foundation stones, which is a flexi cap or multi cap, which has exposures to large cap largely, a flexi cap especially. Have a large cap or a flexi cap fund, add it to your portfolio. Then having a mid cap fund, that's step 2. And step 3 is to add a small cap fund. So that's one is missing. So I think the two funds are good. Axis Midcap and Bank of India small cap fund you can hold. Axis Midcap has not done too well, but I think the damage is done. So quitting now would be like quitting at the trough. So stay on. ICICI Pru Equity and Debt Fund, which is an aggressive hybrid fund, can be exited. And some of the schemes which we told the previous caller as well, which you can see, can be used in your portfolio. But especially the HDFC Flexi Cap will bring in some degree of differential exposure to the current constituents of your portfolio, Mr. Mukesh.
Okay, so those are the advice coming in for our last viewer, that is Mr. Mukesh Kapoor. But moving on, in the next query that we have, Feroz, is also an email query coming in from Reddy Vijay Kumar, and he wants some suggestion on best mutual funds for a 20-year SIP. He wants to keep investing till 2040, and he's currently investing in the following mutual funds. Names are Axis Long-Term Fund on the equity side, DSP Tax Saver Fund, as well as Mirai Asset Tax Saver. So these three schemes is where he is investing right now. But other than that, any fund recommendations where he can stay invested for the next 20 years?
Yes, so I think he has all three ELSS schemes. Again, a fundamental suggestion. If you have already exhausted your Section 80C limit, which has been static from 2014, you may not want to get into a lock-in fund, which is what ELSS is. So just evaluate your voluntary contribution. Involuntary contributions in the form of EPF itself might be eating away the 1.5 lakh limit, which has not been upward revised for the last 8-9 years. So check that. If you're already used it, then don't use ELSS. Stop your SIPs in the ELSS and buy open-ended schemes, which will do better, and you will have the flexibility to take a U-turn. So I don't know about a 20-year scheme. Mutual funds are cyclical. So the extent of review needed is at least every 2-3 years to see whether the scheme is still contemporary and relevant. But as of now, I think the schemes which you can consider are DSP Equity Opportunities, Franklin India Blue Chip, HDFC Flexi Cap and HDFC Small Cap, ICICI Approved Dividend Yield, Kotak Emerging, Kotak Multicap, SBI Contra. These are the schemes you can consider which have a reasonable risk-adjusted potential over the next couple of years. But please try and not hold the same scheme for 20 years. You have to look at your scheme review has to be 2-3 years at least, because all funds are cyclical in nature.
Okay, so that's the advice coming in for Mr. Reddy. But with this, we'll let you go on that, Feroz. Thank you so much for all your time to ET Now and joining with us, not with a very interesting topic on the FPI's inflows and the market correlation. Other than that, helping all our viewers with their portfolio-related queries.
Thank you, Srishti.
Okay, but with this, viewers, it's time to wrap this edition of The Money Show. But before we go, a quick reminder to all our viewers that every day we throw the open stage to get your portfolio queries answered by the top experts, and on your screen you can see how easy the process is. You can connect with us on a WhatsApp number, that is 865-797-4571, or you can also email your queries on themoneyshow@etnow.tv. What you can do is also mention your phone number so that whenever we are live onto the show, we'll connect directly onto the phone line and help you get direct answers from the top experts of the Indian mutual fund industry. Okay, but